Okay. Welcome back, guys. Yesterday we got to take a look at the introduction of what accounting is, get you guys kind of used to a few things, such as what accounting is. Now, this is where we're going to actually start diving into actual terminology and understanding what truly defines accounting. Okay, so definitely this is going to be a section where a lot of the terminology are going to be coming into play. So understanding that we understand these general basic rules and basic terminologies. So let's go ahead and dive right into chapter 2. All right, so again, we're going to start off the day with what is accounting. So again, here's the definition. Accounting is the collective process of recording, sorting, analyzing, and organizing, and summarizing all business transactions. Okay, so all of these things that every time we do a transaction, right, we buy something, right? Depending on what it is, right? Is it something that you made a business transaction, or is it something that you made a personal transaction? So this can come into a play where we need to kind of understand what kind of transaction has happened at hand. Did we buy business office supplies, right? If it did, then yes, that does affect our business. But if you if you just go ahead and went and bought yourself a coffee to wake yourself up, that's actually going to be more of a personal transaction, right? So understanding like how these transactions, how you can take it, analyze it, sort it, and break it down into these individual sections is what this chapter is gonna talk about, right? So first things first is I want to let you know that again we are focusing on primarily financial accounting, right? We're not going to be only dealing with any taxes except for payroll tax, which is a really minor chapter. We're not going to be doing managerial, right? We're not producing a product, so we won't have raw materials or any of that stuff. And then, of course, we're not going to be dealing with forensics. We're not looking in many ways of how we can manipulate the information, right? Our main focus is just focusing on financial information. So here's a quick little guide here of what terminology you'll end up picking up along, such as things like to receive, right? It's going to be a receivable. Pretty straightforward, right? When you pay something, most likely if you pay something, it's going to be an expense. All right? Or if you owe something, that's definitely going to be a payable. All right? Or if you own some kind of type of property, it's going to be an asset. And of course, any obligations that you have, whether you need to make a payment to somebody, it's an obligation, right? That is going to be considered a liability. All right, so here's some, few terminologies, and there are a few things that will come and pick up along as well. So these are just a little icing on the cake, okay? So we'll go ahead and dive right into the very first section. So the very first section is that we need to understand that the main part of accounting is that we need to sort out our transactions, and how we sort them out is based on these 5 different types of accounts, right? So again, the definition of these accounts is some kind of systematic way to keep track and keep record of how you're going to organize your transactions, right? They're going to be based on an asset, liability, equity, right? We've seen this portion before. And then another part I'm going to introduce to you is going to be the revenues and the expenses. Now, here's a few things that you want to know about these accounts, right? They are specifically, there's only 5 and 5 only, right? There's no other account that you can make up, because each and every single thing is going to have plays a huge part in business, right? And I'm gonna go ahead and talk about each and every single one of them after this slide. So first thing that you need to know is that these your assets, liabilities, and your equity will always be considered your permanent accounts. They never close at the end of any given period, right? So take this for example, right? An example of an asset, right? If you have a bank account, if you decide to close your bank account because you're closing up the ending of your, you know, given period, right? Which we'll talk about. What essentially are you doing? If you open a bank account and then close it, what are you doing? What does that mean?
You're putting your money away?
Um, okay. All right, if you open a bank account and then you go to the bank and say you close the bank account, what does that tell us?
Quick question: do I have any balance on the bank account, or am I withdrawing, or just depositing?
Okay, so I open my bank account. Usually you put the first $100, and then a month later, right? I reach the end of my accounting period, and I decide to close out my bank account, meaning take everything out.
Oh,
Sounds like
liquidating?
You're going to
Okay,
another bank?
okay, all
we're
right.
we're closing your business.
You're closing your business. So this is exactly why these accounts never close out at the end of a given period. It's because essentially if you do close it, it just means you're done with the business. So that's why I use the bank, right? If you open a bank account, then you're free to do business all you want, right? Because you have, that transaction that you can record all your, things that you write your check with, right? But the day that you close out your bank account, you're essentially telling the world, right, that you're closing you're closing your company and you don't exist anymore. So that's one of the reasons why they don't close out at the end of the period. All right, I'll give you another example. If you own a bank loan, right? Let's say I owe $50,000. If one day I decide to close that $50,000, what's going to happen? I owe $50,000. If I close it out at the end of the period, what does that mean?
You bankrupt?
It's either you went bankrupt or the creditors are going to come after you for your personal assets. So, again, you technically can't close it. If you owe it, it doesn't mean you're scot free of everything, right? They're still going to continue because they're still going to come after you because that's how creditors are, right? They're going to come after you to make sure that they get the money that you owe them back. So all of this, these three accounts, right? I'll talk about each and every one and what each one entails. And they never close at the end of the period. Excuse me. All right. However, excuse me. However, your revenues and your expenses they're going to be your temporary accounts. Those are the ones that are going to be excuse me, closed at the end of the given period, right? Because here's one aspect. If you think about it this way, revenues, right? It's what you earn for your company, right? A perfect example of earning income for your company is sales. Okay, let's say my closing end of the period is every month. Now, for revenues, can I expect my revenues to be the same every month?
No.
No. I'm going to have different customers. I may have more customers, new customers, old customers, whatever it is. As long as I'm generating revenue, I'm never going to have the same revenues every given month. All right? So that's why it's perfect to close it out because that way it's one way to measure profitability. Because if you start from zero and you measure for this month, right? Let's say I had $10,000 in sales and then I close it out, so I start back at zero. Then maybe the next month I end up getting $15,000. So that's how when I close out at the end of a given period, it's my perfect measurement of how I can tell how many sales I have at the end of the given period. All right. Same thing with expenses, right? There are fixed expenses. However, can you expect that your expenses are going to stay the same every month?
No.
No. right? You have your fixed ones, right? The ones that you have to make your monthly payment to your rent to your landlord. Okay, that's a fixed expense. But what if this month I decided to dump money into advertising because I have a promotional sale, right? But then maybe next month there's no holiday, so there's no holiday. I'm not gonna spend any extra money to do advertising to market myself at all. So expenses are variable, right? So are sales. Okay, so these are two perfect measurements of how we can determine how much sales that we have at the end of the month and how many expenses at the end of the month. And again, these two are the two components in order for us to create the profit and loss, right? We take all of our income, we subtract it all by our expenses to determine our profitability for the given period. So again, these ones close out, and it will make all sense once we go through the entire process of this class and we actually take a look at closing the books and actually producing our financial statements, and you'll understand why it's necessary that we have to close out our revenues and expenses. Okay, but just a little key term factor: your permanent accounts are going to be your assets, liabilities, and equity. Your temporary accounts are going to be your revenues and your expenses, and these five are the only types of accountings that you have, types of accounts. Okay, so let's go ahead and talk about how we list our accounts. So here we are going to talk about how we determine which accounts function for our accounting, right? We have a main account, a sub account, and a contra account, right? So, for example, I have here are my assets. So, I have here my main accounts is my cash. I have accounts receivable, and I have inventory. Those are my main accounts. They're kind of like a general umbrella organization, or they're the main topic of the chapter, right? If you look at as a table of contents, right? If I break it down, right, depending on what it is. So for example, if I sell inventory, right, that means I can sell anything. I'm not being specific, but if I want to be specific and say I sell coffee mugs, then that is a perfect example of using a main account with a sub account, saying that I broke down my main account into further details and saying that I sell coffee mugs. I don't sell inventory, I sell coffee mugs. All right? I can sell coffee presses. I can sell actual coffee, right? So this is a perfect of example of how the main account and the sub account work, right? Just like the table of contents. If the main content is inventory, right? What I'm going to learn are your subtopics, which is I'm going to learn that I have coffee mugs as part of my inventory. All right? Now, in this kind of aspects, when we understand what a normal balance is, which we will get towards the end of this chapter, the normal balance is in which direction does the account normally flow in. All right? So, again, this doesn't make sense now, but usually the main account flows in a specific direction, and the sub account flows in the same direction as the main account. All right? A contra account is pretty straightforward, right? We understand the main key term here is contra. Controversy, right? It means the opposite. So that's exactly what is applied here as well. If you have a main account and a sub account, you have an opposite flowing account called a contra account. And what a contra account normally does is it decreases the main account or a sub account. Okay? So for this example here, and we will dive into this further on in chapter 10, when we look at accounts receivable is going to be the money that people owe me. right? My customers owe me. This contra account is the allowance for doubtful accounts. This contra account I've created because it's a potential placeholder that I made up to hold accountable for the customers that are not going to pay me. So therefore, it's going to reduce the amount that people owe me because I'm going to write it off as a loss, right? It's money I'm not going to be able to collect, while my accounts receivable are money that I will collect. All right? It doesn't make sense now, but it will make sense later. All right? So the definition for each one is a main account is a general account that typically flows in a specific direction, right? The sub account gives the main account more detail and typically would flow in the same direction, all right? Where a contra account, it gives either the main or the sub account more detail. However, it flows in the opposite direction with the intention to decrease the value of the main or sub account. Okay? So again, this will make sense when we take a look at our chart of accounts, which we'll introduce in chapter 3. Okay? Any questions so far?
No.
Okay.
You sound kind of far away.
I sound kind of far away? Do I sound, am I,
A little bit, yeah.
is it better now?
You don't seem far away from me.
Okay. Give me 1 second. All right, so back to the PowerPoint. Now, here's something that is going to be the most important idea when it comes to understanding accounting. All right, we have what's called debits and credits. And how we interpret debits and credits is how we utilize it in when we we understand how to use debits and credits when we look at our accounts. So instead of looking at it as increase or decrease, we're going to look at it as if debit means left and credit means right, okay? When we start talking about the normal balance and we start looking at the accounting model, we're going to see some kind of sequence or some kind of flow in directions when it comes to actually understanding what a debit and credit does. It doesn't mean you're going to decrease an account, and it doesn't mean that you increase an account, because when you're looking at a specific account, you could be increasing account with a debit, but at the same time you can also be decreasing an account with a debit. Okay, so don't ever refer them as increase or decrease. Now, the best way I can let you guys understand this concept is think of a debit and credit as if they're on like a scale, right? The more left you go, the more left that you go, right, the heavier it's going to get, right? And in order to balance that out, you would have to add the equal end amount of credit, right? Where the middle part is 0. So if I go left to increase an account, I go left 10, I would essentially have to take all those marbles, right, and place them into the credit, the exact 10 amount, in order to get to 0. All right, so understand it like a number line, right? You have the positives and the negatives. Well, that's actually worse. Think of it as like a scale. So in order to understand how the flow of a direction goes, all right, we use debits and credits to determine whether we increase an account or decrease the account. All right, so for now, just understand that debit means left, credit means right. Okay, and of course, we are going to always look at this fundamental accounting equation, right? Assets should always equal your liabilities plus your equity. All right, no matter what point in your business, this equation must hold true at all times. Okay, it is once again, it is the fundamental backbone of all businesses, right? If your assets is everything that you own, it should be equal to everything that you owe and the value of your company, right? So now we're going to dive into the assets, liabilities, and equity accounts. So first things first is we're going to look at our assets. So once again, your assets are going to be anything that you own, okay? Whether it's your bank account, whether it's inventory that you're planning to sell, right? If you make purchases of inventory, who owns the inventory? You do, okay? Until you sell it, then you transfer the ownership to someone else. So in this case, that also applies. We also have fixed assets, right? Anything you own the building, you own the plant, you own the parking lot, right? That's going to be considered something that you own. All right, and how they are divided, or I guess more categories, right? We split them up into categories, and it's going to be based on the liquidity of each item, right? How quickly can you convert it into cash, right? Usually, cash should be the first thing that should be at the top of your asset list. It's the most current type of asset because it's already in its simplest form. Inventory is considered a current asset because you can go and take that item and sell it to get cash. All right? Now, the other categories are going to be fixed and other. All right? So, if we are categorizing my assets based on how quickly it can be converted into cash, now let's take a look at fixed assets, right? When you make a purchase either of a property, plant, or equipment, it's also known as that PP&E. Corporations, they primarily use fixed assets as PP&E. Let's say I make a purchase of a building. How long will it take me to convert that into cash?
Until you sell it?
Yes, right? Exactly. We don't know. It could be 6 months, it could be 12 months, it could be 3 years, right? We don't know because especially when it comes to selling a building, right? If we acquire a building and we decide we're done with the business, we need to sell it. You have to go through property management or some kind of realtor company. You have to put it on the market. You have to go get it appraised and then put it on sale. Then you have to have potential buyers to take a look at your property. Then, if a potential buyer likes your property, then you have to go into escrow. And then you have to go through all that because they have to check their bank account status, blah, 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 blah. And then you never know when you'll end up closing the escrow. So how quickly do you think you can convert a building into cash? Not very quickly. So that's why that's going to be considered after all those current assets. Okay. So anything like for anything like if you purchase a furniture, if you buy a new piece of furniture, how quickly can you sell it back out to the public? You gotta go, take a picture of it, post it on Facebook, ask to see who is interested in buying your furniture. They have to come to your house. They have to look at the furniture to see if there's any dents or anything in it. It takes forever to convert it into cash. So that is why the best way to understand this is to determine, is it a property, is it a plant, or is it an equipment? Usually those are the three categories that you can understand that those usually would be a fixed asset. And normally they actually have some type of life to them. And when I say that, you'll understand when we when we dive into depreciation, right? When we need to depreciate our assets, which is in chapter 11. So that is going to be a quality that most fixed assets should have. They have they have some kind of life expectancy to for just being in your company. All right. Now again, property is anything like your land, right? The parking lot. Okay, your plant is going to be your building and anything that's in the building. So your furniture, your lights, your lamps, anything that's in there. And then your equipment is going to be anything that helps you produce either the product or help you manufacture or even help you package things. So usually those are like machinery. Printers are also going to be considered as a machinery, right? Anything that has like electronical work to it, that's going to be considered an equipment. So if anything that you purchase falls in between those three categories, then you're going to consider it as a fixed asset and you're going to put it below all your current assets. Okay? Last but not least, the last category is going to be other assets. So other assets have one unique feature. It's going to be primarily anything that's intangible. So, for example, right? Deposits are intangible. Prepaid rent is intangible. Patents, copyrights, licenses. Now, I'm going to tell you, if you made a prepayment to rent, can you physically touch rent?
No.
No. You can touch the contract, but in this case, what is the idea of the acting upon rent? Can you actually physically touch rent? No. Right? That's intangible. Same thing with the copyright, right? Can you feel that protection over your idea? No, it's an invisible shield, right? So in that case, those are going to be considered your intangible assets, and most likely these kind of assets, you will guarantee never get your money back. Okay? So for example, if I paid rent to my landlord and I say, I don't like you, I want my rent money back. Do you think they're going to give it back to you? 100% not unless you go into legal, you go call yourself a lawyer and you fight with this landlord saying that this landlord did all these things that were wrong. At the end of the day, you may slight chance win that money back, but how much money do you have to spend in order to get your lousy rent money back, right? So at that kind of idea, it is definitely very, very, very hard to get your money back. And yes. Okay, so that's the idea here. These are the three categories of how we determine our assets, right? They're split based on how quickly it could be converted into cash, all right? So my current, my fixed, and my other assets. Any questions? Okay. Yes.
I got. So on the fixed asset, we're not. What is it? Depreciation. We're not adding that into there right now.
It depends because it depends on when you acquire the asset. Okay. Usually, again, that's not something that we learn right now. It's going to be in the future. So hold that question until then.
Okay.
All
Will do.
right.
Thank you.
All right. So again, assets are everything that you own. So whether it's the cash that you have, the inventory that you own, the building, the furniture, the patents, whatever it is, it's everything that you own. It's your name is on there. It's yours. Okay? Then we have liabilities. Liabilities are going to be everything that you owe. OWE, okay? So typically you would owe to either other people or you would owe to the bank. Those are usually general the rule of thumb here. You normally would have those types of liabilities, okay? So how we categorize our liabilities is that there are two categories. And what they're based upon is the length of time that you owe them for. So, for example, an accounts payable, right? Let's say you go shopping at a store, and they offer you a store credit card, right? And when let's say you purchase something and they send you a bill. How many days do you have in order to pay for that bill? Typically,
30 days.
30, yeah.
30 days, okay? Maybe you have a payment plan going on, so you have either 30, 60, or 90 days, right? So that means if it's less than a year, it's going to be considered a current liability. So again, accounts payable are most likely when we have accounts with our vendors. Typically, a bill is is normally outstanding for either 30, 60, or 90 days. Usually no more than that. Okay? A notes payable. A notes payable is a promissory note that you owe somebody. All right? And whatever agreement you have, the difference between that and a regular accounts payable is that you can negotiate an extension for payment options, right? Let's say I want to defer my payment, right? Then that's where the fine line says that it's not solid. And so it can be a current it can be, I'm sorry, a current liability because, right? Maybe I owe this person for 3 months, but the difference is I can extend my payment for even further or even longer out. So that's what a notes payable is, okay? And typically you would have your sales tax payable because when you collect sales tax, is that money really yours?
No.
No, it belongs to the state. Yes, it belongs to the government. It's not even your money. So we'll take a look at that when we dive into chapter 5. All right, well, chapter 6. 6 is sales. All right, so now we're going to talk about long-term liabilities. So anything that you owe longer than a year. So typically anything that has a loan attached to it, so business loan, bank loan, student loan, what is it? Homeowners loan, they're all going to be longer, at least typically longer than a year. And it depends on what the agreement terms are, what the annual percentage rate is, and how often you're going to pay it. Okay? So typically, anything with a loan is going to be most likely a long-term liability. Okay? Anything that you owe for more than a year. Pretty straightforward. All right? Now, here's a little, I guess, food for thought, I guess. We need to understand that liabilities are not debt. Okay? In context, yes, you owe the bank, yes, you're in debt. But in accounting terms, we determine liabilities as an obligation. We are obligated to make payments because we owe money to these people. Okay? So never refer liabilities as your debt, refer them as an obligation that you must pay. All right? That's just only accounting in context. If you're out in the real world and you're just talking in general, you can use it as debt. Okay? So again, once again, liabilities is everything that you owe. O-W-E. Okay?
You said that was determined by the length that you have to pay them back?
Correct. It's going to be, yes, the time that you owe them for. Okay? So here the criteria is current liabilities are less than a year if you owe them less than a year, where long term is more than a year. Okay? All right? Then we talked about equity. Equity is going to be your net worth of the company, right? It's going to be what your outstanding net worth, again, sorry, but like what the company's standing at, right? If my company is valued at $30,000, then that means its net worth is $30,000, right? Now, here's one thing, and I'm going to test you on this, so make sure you select the correct answer, okay? Equity does not have any categories. Once again, I will test you both on the test and the quiz. And if you answer something else, again, equity does not have any categories. All right? But here I listed in this little box right here are examples of what you typically would see in equity, right? Just like from here, I have my categories here, but on the right side, I have an example of what they are. This is an example of what affects your equity, right? Capital contributions, right? That will increase your equity because you're investing your own money into your company. Also, if you have a withdrawal, you're taking money away from equity, okay? So again, these are examples of equity accounts, not categories. All right? Another thing that affects equity is going to be your profitability or your income. All right? So your revenues minus your expenses, which you generate a profit or a loss. If you choose to reinvest it into your equity, then that will determine whether you increase it or decrease it, right? So, yes. So now this is a leeway to the next section. Revenues and expenses. So here I do have categories for my revenues, or also known as income. You can interchangeably use them. Whether you know them as revenues or income, they mean the same thing. Okay? So here we understand that income or revenues is any type of way that your company essentially earns some kind of money into the company, right? So the best way to do that is by determining whether our company provides a service or it sells a product. Now, if you remember from our conversation yesterday, our main goal and purpose of this class is we're focusing on a merchandising company. So our typical operating core revenue is going to be our sales. Okay? So operating is anything that is involved with the company. What is the main core of the company that's generating this revenue? And in this case, it's going to be our sales. Okay? Now, let's define the other two categories. Other income can result in other ways and other means of income that helps generate for your business, right? But it's not your main core operations, right? So, for example, if I sell coffee, right? My main core is to sell coffee. But if I have a delivery service charge, that's not my main operations. I'm not in the business of delivering. I'm in the business of making coffee. However, that's going to be helping my business because I can use that delivery charge to help serve my coffee. Yes. So it's not directly correlated to my operations. It's indirectly. Okay? It helps generate income for the main core operations. Okay? Now, also, what a lot of companies also do too here is they use other income as, if they're partners with other agencies or other companies, right? You can partner up with two companies, right? Where you hold a specific shareholders or you own a part of the company, and what you do is you rely on each other to split the income, then that can be considered other income. And that's going to be more advanced level of accounting. But it's definitely good to know that if you do end up partnering with another company, you can justify your other income because it's not your main core of your business, but you're getting profits from the other business that can be contributed as other income. Okay. And then we also have non-operating revenues, which is essentially the same thing as other. Okay, they're terminologies that you can interchange, right? Other or non-operating. So once again, if it has nothing to do with your main core of the business, it's most likely going to be non-operating. All right. So only two categories, right? Because the second category can be interchangeable between other or non-operating. Okay. Then we have our expenses. Expense, because we are dealing with merchandising inventory, right? We sell products. We have to have a cost of goods sold. All right. You can apply a cost of goods sold for a service, but that's going to be a little different here because it's more likely going to be cost of service, not cost of goods sold. So in this case, what the cost of goods sold does is it's directly correlated to your sales and it's directly correlated to your inventory item. All right. So again, when you sell an item, right, you need to expense it in your company to let you know that when I made a purchase of my inventory, right, how much did it cost me to purchase? So if I got rid of it, how much did it cost me to sell it? And that's essentially what cost of goods sold means. And again, this will make a lot more sense when we dive into sales. Okay? So we have that category, and then we have operating and non-operating. Operating expenses are anything that's going to be expenses that you occur in order to run your business. So perfect example is going to be rent expense. Rent expense, of course, if you in order to operate your business, you need a location. And in order to have the location, you need to pay rent. So that's a perfect example here. Now, I'm not going to really test you on non-operating expenses because we are a merchandising and we're looking at a small scale type of business. So you wouldn't encounter non-operating expenses as much as you would if you were a little bit bigger. But what a non-operating expense can entail is what if you need a facility to have weather or temperature control for your inventory items. But you can't have that in the store, right? It's like something that you stock up in the back. Maybe you have a warehouse, right? And so you have to pay a facility, the warehouse, to hold your inventory. You need to hire security to protect those assets so that no one goes in, breaks into the warehouse and steal your goods. So those are going to be considered non-operating because they are not within your business. Okay? So for example, right? If I have rent, wherever my store is, that's going to be my main operating expenses. Wherever my store is not is going to be your non-operating expenses. So most cases, some warehouses or for example Walmart, they have the parking lot in the back, so they need to pay for all those trailers, all of that whole entire back lot space to hold all their inventory items. Okay. And that's going to be considered a non-operating because the operating is in the actual store where they're actually selling the items, where the non-operating is just holding the items for storage. Okay? Does that make any sense?
Yes, but I have a question.
Go for it.
Um, because as you were talking, I was thinking in my head of a non-operating expense, but then what you just explained, so I'm going to ask my question.
Go for it.
In my store where I sell my goods, say if I have a coffee bar set up for my customers and I don't charge them, would that be a non-operating expense or would it be an operating expense since it's inside my store?
It would be an operating expense because you said you have it for your customers and you don't charge them, right?
Right.
So is that part of your service? Is it complimentary?
Yes.
Then that's going to be a regular business expense. Or if it's a part of the, customer fee or whatever it is,
Hmm.
Usually complementary items are going to be just considered a regular business expense. So yes, it is operating.
Okay, so basically what you're saying is your operating expenses would break down into little sub things as far as your different expenses, then, right?
Correct, but in generally, you would just tie them all into your operating expenses.
Okay.
When you go into more advanced accounting, you're gonna learn that there's administrative expenses, fixed expenses. It breaks down even further. But I don't want to boggle you down with advanced material stuff. I'm only gonna bog you down on just the very basics. Okay? So yes, if you pursue accounting, you will learn that there is a way that expenses even gets broken down even more. Operating is not its final line. It goes beyond that. Okay. Um, Good question though. Any other questions?
So operating expense be like paper, everything you need to, printer.
What do you mean by that?
I'm just saying like anything you need for the office, like pens, paper,
Okay.
staples, or is that an operating expense or no?
You can treat it as an operating expense, but you can also treat that as an asset. Okay. Now, in this class, I will teach you that when we buy office supplies, we're going to treat them as if it's part of something that we own. And then at the end of the given period, right, we're going to count our pens to see how many we have that are unused. And we're going to treat expenses as if we use those pens. That means they're worth nothing anymore. So we're going to treat that as an expense. All right. So the true definition of expenses is going to be pretty much anything that you need to use, to pay for, or to get rid of. Okay. So when we talk about cost of goods sold, right? When you sell an inventory item, what did you do? You got rid of it. You don't have it anymore. So that's going to be considered an expense. When you use something such as office supplies or coffee cups, even if you bought a bunch of coffee cups, or even if you bought printer paper, and let's say out of the 5 stacks of coffee paper I bought, I used 2 packets. I can treat that as an expense, right? Because I used it. I don't have those 2 stacks of paper anymore. Okay? And then other things such as rent expense, right? That is a necessity I need to pay for in order to operate my business. All right? So expenses kind of have that kind of definition. It's either to get rid of an item, to use an item, or to pay for something that you need to in order to operate your business. Okay? So advertising expense, right? That's something that you need to pay in order for it to operate your business. Okay? Hopefully that clarified your question.
Yes.
Okay. All right. Any other questions? Okay. So those are our 5 account types, and those were all the categories that you would normally see when it comes to understanding how we take a business transaction and divide it or categorize it in its specific account and account category. So now we're going to finally talk about the accounting model. All right? We're going to start off by understanding what the normal balance is. So, if you read the pages, this is on page 2 of chapter 2. The normal balance is going to be the side that is on the positive side of which in a specific account increases on. All right? There's a lot of mumble jumble. So again, it's going to be the positive side in a specific count that it increases on. So this is where I'm going to give you a couple examples of how to use that scale idea, right? Using the debits and using the credits idea. Okay? So here, let's take a look at assets first, right? Assets normally have a a debit balance, right? You normally increase it more often than you would decrease it. However, let's go ahead and take this into context, right? If I deposit money into my bank account, how would you increase my assets?
Wait, could you repeat that?
So use the context of debits and credits, right? If I have a bank account, which is an asset, right?
Yes.
And I deposit money, so I'm increasing my assets. How do I increase it? What would I
Adding
use?
more?
Say that again, Nicole.
What was you said? How would you add more?
Correct. How would I interpret this transaction? If I'm increasing my assets, how would I increase my assets? Like what? Okay, I'll give you a little more context. Would I use a debit or would I use a credit?
A debit.
I would use a debit. Yes, sorry. Maybe I didn't ask that correctly. So in this context, I would use a debit because I'm increasing my assets, right? If I'm putting money into my bank account, does that mean I have more money or less money? I have more money. So therefore, I'm increasing my account. Now, what if I write a check out to my landlord for X amount of money?
It would decrease it.
It would decrease it. So therefore, what would you do?
Credit it.
You would credit it. Correct. So in this case, use the balance scale idea, right? If you put 10 pebbles on the debit side, that means you have money. But let's say I need to transfer 5 over because I had to pay for rent. Therefore, I have to tip the scale over by crediting it for five credits. So therefore, you know, they're going to be balanced. But in this case, I have 5 on my debit, and it's going to be there because I had 10 earlier, right? So, yes. I don't know if that made any sense. Okay. But yes, in order to decrease your assets, you would have the credit, right? So if that rule applies here, right, that doesn't mean that applies for every single account. As you can see, if we go right over next door to see what the liabilities look like, it's going in the opposite direction. So if I increase my liability, right, let's say I got a business loan, and I increase the amount that I owe, what am I going to use?
If you increase the amount that you owe, you would credit it.
Correct. But let's say I pay off my liability. I start paying my loan off. So
Debit it.
you would debit it. Correct. All right. So good. Now we kind of understand how it kind of works, right? Now,
So for each category, it varies.
yes, for each category it varies, right? Your assets are more likely to be increased by a debit, and your expenses are going to also flow in the same direction. All right, that's one way of you can memorize it. Your assets and your expenses are going to be increased by a debit, while everything other, so your revenues, liabilities, and your equity are going to flow in the opposite. So meaning they're going to be normally increased by a credit. Okay? All right? Now this will make a lot more sense when we actually dive in to actually journalizing a transaction for the first time, which we get to take a look at in chapter 3. Okay? So I'll throw in another example. Let's say I had to buy advertising expense. Okay? If I had to buy advertising expense, what am I doing to my expense account?
Crediting it.
Not credit.
No.
How's
What
that
are your-
debit if you're buying?
Yeah, it's debit.
Yes. Okay, in context of my expense, if I'm looking at increasing my advertising expense, I'm going to increase it with a debit. However, I did say buy. So, good catch there. If I'm buying my expense, I'm going to decrease my assets. Okay, and this all is going to make sense when we dive into understanding single entry and double entry. All right, which is going to be coming up soon. All right, so good. If I'm making a purchase of advertising expense, I'm increasing my expenses because I need it for my business. However, in return, my polar and opposite credit is going to be my assets. I had to pay for it. So therefore, I needed to decrease my cash flows. All right. So again, we'll talk more into that when we dive into understanding single entry and double entry. All right. So far, is everyone okay with this? Okay.
Makes more sense than trying to read it out of the PDF.
Oh yeah, definitely, 100%. So once again, we'll go through a lot of examples of transactions and understanding how to interpret, because chapter 3 is all about transaction analysis. How do we take a look at a source document and be able to convert it in terms of debits and credits, and how do we journalize it? So in this case, we're all here. All right, this is very, very important. You can keep this slide. Again, it's also on the end of the PowerPoint. You have the chapter 2 review. You have it there, and if you want to, you can also print it out. It's page 5 in chapter 2, and I will also attach a separate form on the Google Classroom when we get closer to the exam. I'll post that in the study materials folder so you can have this, and this is going to help you a lot, especially when you're trying to understand where everything goes. How do you record it, especially using the debit and credit system? Okay, so next is bookkeeping system. So I've mentioned this before. We have a single entry and we have a double entry. All right. So the real difference between this is going to determine pretty much the use of how we use debits and credits, right? A single entry only allows me to take one account and only measure one direction. All right. So that's going to be considered a single entry. Where your double entry, you're going to have some applied science in here, right? If I'm going to have a debit in one account, that means I must have an equal and opposite credit balance. That's how you determine double entry. So a great example of how this works is, right, if you remember back in the day, if you still use it now, you guys had a manual checkbook, right, from the bank. At the very top of it, you have that little register that you write down your note saying, I made a payment to this, I used this check number, and I wrote it to this person. That's a perfect example of a single entry, right? Because I'm only noting it in one place. I'm only placing the information that I wrote a check out in my checking book, right? But if I were to go ahead and do this for my double entry, in that case, if I were to write that information in my checkbook, I have to write where that check is going to. So my equal and opposite credit, right? So if I wrote that check out to pay for rent expense, then I'm going to debit my rent expense because that's where the money went, and then I'm going to also put an entry in for my checking account because I took money out of it. And then for this class, we never use the single entry, okay? We will always use double entry because we need to ensure the accounting of the accuracy of our accounting, and that's exactly where when we piece everything together, that's where the trial balance comes into play, right? Because if you wrote out a debit, your equal and opposite credit, right? You need to have equal and opposite credit, So therefore, at the end of every single transaction, all your debits must match all of your credits. So at the end of the day, you're always going to have a balanced journal, okay? A balanced entry at all times, okay? So, as I've mentioned this before, we're not going to ever use single entry. However, in QuickBooks, you will see how the single entry will apply, and what happens in the background is it does the double entry behind the scenes. Okay? However, for this class, the accounting class, I'm teaching you manual bookkeeping. You're going to understand that when you journalize, you need to have two accounts with two balances, one in the debit and one in the credit. Okay? Now, again, that may not hold true all the time. You don't need to have just one credit and just one debit. You can have multiple credits equaling to one possible debit. Yes, you can. As long as this statement holds true, all your debits are going to equal all of your credits. Okay, so you can list out as many accounts on the debit side and as many accounts on the credit side as long as they equal to each other. Okay, but for most cases, most of our transactions are very straightforward. Usually one account is affected and you have the polar and opposite account that's also affected. Nothing more. Okay? Any questions? Okay. Okay? Again, it will make a lot more sense when we dive into chapter 3 when we understand how to journalize everything. So once again, here's the course chapter review. We understand what accounting is, right? It's the sorting, analyzing, summarizing, organizing your data, particular business transaction, right? We have the 5 account types, right? Assets, liabilities, equity, revenues, and income, or revenues and expenses. We have the accounting equation right here. Your assets must always equal your liabilities plus your equity. We have the normal balance here, right? Assets will generally have a normal balance of a debit side. So again, the normal balance definition is the side that increases in a specific account, right? And then here we have the list of all the different types of accounts with their respective categories. So again, my temporary accounts are my income and / revenues. I have 3, right? I have either the operating, other, or non-operating. And then I have my expenses, again, same 3 except cost of goods sold, operating and non-operating. Here on my permanent accounts, I have my assets, liabilities, and equity. The 3 categories here, the 2 categories for the liabilities. And once again, I even put it in bold capital letters. Well, not bold, but capital letters. Equity does not have categories, but these are the 2 features that affect it. All right, it's important that you know these 2 because these 2 are one of the things that you need to know. Okay, any questions in regards to chapter 2? Okay, so let's see if we're good on time.
I'm sorry, I have one more question.
Yes.
What was the normal balance?
The normal balance is going to be the side of which has is positive on the specific account that increases it on. So in this case, if I were to ask you, what is the normal balance of an asset? What would you tell me?
What is the normal balance of an asset?
Correct.
A debit?
Correct, because what increases an asset? Your debits increase the asset. If I were to ask you what the normal balance of a liability is, you would tell me a credit because credits increase the account. All right?
Side of which side is positive in a specific
account which it increases on. So in this case, the normal balance is the positive balance that increases in any specific account. So in this case, I'm looking at what typically would increase each account. That's going to be the normal balance. Okay. All right. Okay. So looks like we're good on some time here. So let's go ahead and complete the chapter 2 exercises. Okay. And then we'll call break. All right. So let's go ahead. Number 1. Okay. What are the five types of accounts?
Assets, liabilities, equity, revenues, and expenses.
Good. Assets. Okay, I'm going to do liability for sure, okay? Equity, revenues, okay, again, you can interchange revenues. Ooh, my typing is so bad today. With income. Home keys, girl. Income, and then lastly, expenses. Okay, and I spelled equity wrong. I forgot the I. There you go. Revenues slash income, right? They're interchangeably, and expenses. Good. Now, what is the definition of a main account? What is a main account?
It's an account that makes up a list of a certain type of account.
Perfect. Can you repeat that again?
An account that makes up a list in a certain type of account.
An account that makes up a list of a certain type of account. And usually another definition would be that it normally flows in a specific direction. It flows in a specific direction. Now, when I say specific direction, what I mean is, does it flow to the left or does it flow to the right? So is it normally a debit balance or is it normally a credit balance? Okay. What is a contra account?
Gives the main account more details.
Yes, it gives the main account more details, but what specifically makes a contra account unique?
Let's see. I have found in the main account and are recorded opposite or contrary to the main account.
Good.
For decreases equity.
Okay, I don't know about the decrease in equity, but okay.
Debits and the credits that flow in the opposite direction as the main account.
Mm-hmm. Okay, so this one would normally decrease an account. Any account, right? Okay. All right, and again, contra accounts can be for either main or sub account. So don't forget that. It's not just specified for only main accounts. You can have a sub contra account. It's more complicated, but yes, you can have it. It can apply for both a main and a sub account. All right. A contra account can be for both main and sub account. All right. Okay. What does left mean?
Debit.
Yep. And what does credit mean? I'm sorry, what does right mean? I just gave you the answer. What does right mean? It means credit. Okay. All right. Always associate left and right as debit and credit. Okay. So again, the reason why I want you to associate it is because when we dive into chapter 3, it makes sense once you see how the journal looks like. All right. Number 6. Okay. What is the accounting equation?
Assets equal liabilities plus equity.
Assets equals liabilities plus equity. Good, right? I use equity because it depends on what your company is, right? Corporation, your stockholders' equity, partnerships equity, owner's equity. But in this case, just use equity if you're not sure what your type of company is. Okay. Number 7, what are the 3 categories of assets?
Yep. Current assets,
Mm-hmm.
fixed assets,
Mm-hmm.
and other assets.
Good. What are the 2 categories of liabilities?
Current liabilities and long-term liabilities.
And long term. Term. All right, number 9. Okay. What are the categories of equity?
No categories.
Good, no categories. And like I said, if you guys answered this wrong on the exam, I just don't know what to say. No categories, okay? As much as I'm trying to emphasize it, please remember there's no categories in equity.
Sub accounts, right?
There's not sub, they're main accounts. Yes. You have a main and a contra account in there. All right. All right, number 10. Okay. What are the categories of expenses?
Cost of goods, operating and non-operating.
Good. So I like to shorten up cost of goods sold as COGS. So I would very like if you guys can also do that as well. Operating and non-operating. Ooh. Yeah, my typing is really bad today. What are the categories of revenues?
Operating and non-operating.
Good. Operating and non-operating. All right, number 12. What are the 2 accounting systems?
Single entry and double entry.
Yes, please do not ever refer them as single and double, right? And you need to have that little extra piece to kind of get what you're going at, right? It needs to be single entry and double entry. Because if you just say single and double, I have no idea what you're talking about. Right? You can have a single a lot of stuff and a double of a lot of stuff. Okay? And then lastly, 13, what is the normal balance?
The positive balance found in any specific account.
The positive balance found in a specific account. But what constitutes as a positive balance?
It is the number that is on the increasing side of the ledger account.
Good. So specific account. All right. Or also, I'm just going to go ahead and write increasing. That increases. Okay. Right. And then 13. Okay. I'm going to go ahead and test you on how to do this because this is very important because this will show up on the exam. So what I'm going to do here is for number 14 is these are examples of accounts, and how I want you to determine these accounts is first I want you to recognize what the accounts are. Second, I want you to determine what type they belong to, what category they should fall under, and lastly, what kind of normal balance would they tend to have. So again, this is applied knowledge for exactly everything in chapter 2, but crammed into one little chart. Okay, so up here I have little key things, so I'm going to use acronyms, but know that the acronyms mean these things, right? We only have 5 types of accounts, right? It's either asset, liability, or equity. In this case, I have owner's equity, and I have the revenues, which you could do R or I, and I have expenses, right? Where the categories I have our everything here, right? We have current, we have fixed, we have other, we have operating, cost of goods sold, um, long term, etc., etc. Okay, so let's go ahead and go through each one and determine where each one belongs to. So, first things first, we have a checking account. So this is going to be money in the bank.
That would be an asset.
That is 100% an asset. Yes. Okay. Now, what kind of asset?
Current.
It is 100% current because it is already in its simplest form, right? It's already in cash, right? You just have to withdraw it. And then for this kind of asset, how would you normally increase it?
The debit.
With a debit. Good. Right. In this case, I'm gonna use D and C. You guys can understand that, right? All right. Now, here's the next one. Accounts payable. Money that you owe to vendors.
Liability.
It is going to be a liability, correct? What kind of liability?
That would be current also.
It would be current because the hint here is that you're owing money to other vendors. Typically, they're only going to let you owe them for 30, 60, or 90 days. Okay? And what kind of normal balance would a liability have? It would have a credit balance. Good. It would increase with a credit. Yes. Right. What about a copyright? A copyright is a legal documentation of ownership or a right.
Would that be owner's equity?
Okay. What is the definition of an owner's equity?
Oh, wait a minute. Okay. Well, owner's equity would be something that you own.
No.
Oh, wait a minute. Oh, no, owner's equity would be everything together that makes up the business.
Correct. In our terms, to completely understand what it is, it's just what your net worth is. It's just what your company's worth. It's valued at. So in this case, does this pose any value to your company?
So that would be an other asset because it's a non-tangible.
Correct. Right? You own it. The key word here is that you own it or the right to it. Okay? Second of all, it's intangible. You can't touch a copyright. So therefore, yes, so Nicole is correct. It is an other asset. And what would you normally have a balance for? What would the normal balance be for an other asset?
That would be a debit.
That would be a debit, yes. So again, if you have that page or the PowerPoint with you, use those arrows because that's going to definitely determine how it flows. Okay?
So we said the category would be
Other. Right, because it's intangible. Okay?
type would be
An asset because you own it. You own its ownership. You own the copyright. All right. So then, what about supplies? Now, we kind of briefly talked about this earlier. It's going to be supplies that are needed to operate the business. Okay?
Is that an asset?
It is an asset because essentially when you go to the store and you purchase it, right? Are those pens yours?
yeah.
Yes, you own those pens now because you bought them. So yes, it is an asset. Now, here's a trick one. How would you determine this type of asset?
It'd be a current, right?
It would be current. Why would it be current?
Because
Oh,
it's
that's
something
right.
that we have to make the business run.
Correct.
Said it earlier.
You can also, if I don't want my pens anymore, I could easily sell it to a customer or be like, oh, I'll sell it to a friend. Boom. cash
Be
can.
cost of goods.
Well, if you do supplies as inventory,
Yeah.
then yes, it's a cost of goods sold. But in this case, I don't need this paper anymore. Oh, I'll sell it to you for $5. Okay, yeah, I'll take it off your hands. Right? If you want to be
Yeah.
generous, you can give it away for free. Usually that is one of those scenarios, but in this case, you can sell those supplies right back out there. Or you could go to the store and return it. Right? You still get your money back. So in this case, yes, it is a current asset. Right? Now, what kind of normal balance would this have?
Debit.
It would have a debit. Yes. Okay. All right. What about loans? I took out a owing money to a bank. Okay, over a period. It is 100% a liability. Yes. Now, what kind of liability?
Wouldn't that be fixed? Because a loan is usually over a long period of time.
What are the categories of liabilities?
Current and long
I say
term.
it's long
Oh,
term.
that's right.
We only have two categories, and fixed
Right.
is not one of them. No, this is practice. This is learning. All right. I don't expect you to get it right the first time. All right. But it's definitely something we can practice on together. So yes, there's only two categories: current and long term. And in this case, most loans, right? What do you normally see loans as?
Long term.
It is 100% long term, right? I mean, besides a short term loan, which if in case it is a short term loan, it pretty much tells you it's a short term loan. So, again, most often cases, loans are anywhere from 1 year to 30 years, right? Depending on what you're getting the loan for. And what kind of balance would it have?
Credit.
It would definitely have a credit balance, all right? What about accounts receivable? So customers owing the money to you, or owing the business money.
Accounts receivable is a current asset.
It is a current asset, right? Essentially, you can go bother that customer to get your money back. So in this case, it's essentially as if you have invisible cash, right? It's a bunch of IOU slips, right? You could think of it that way, right? When you sell something to a customer and they say, I want to put on an account, that means that person's got to write an IOU to you. So then one day, when you send them a bill, you tell them, hey, I'm here to collect your IOU. And they must give you money. So that's the best way of understanding that. And yes, it is 100% a current asset. Now, what kind of balance would it normally have?
Debit.
It would definitely have a debit balance. All right. Now, here's a tricky one. A owner's withdrawal. You are taking money out of the business.
Expense.
Okay, technically it's not an expense, right? Because, you know, it's not the cost of doing business, right? If you're taking money away from the business,
Oh, okay.
okay, then you're not, that's not technically a cost that you would do in order to do business. Why would you take money away from business and have it as an expense?
Okay, I understand.
Mhm.
Liability then?
Now, do you owe your
Oh, no, I'm
taking the
sorry.
money out?
I
That's okay.
I'm getting these words are in my head is getting switched around.
No worries.
That would still that would be an asset then, correct?
Well,
It's-
you technically own the money, but in this case, I'm taking it away from the business itself. Okay, so if you remember, you can take a look on the PowerPoint. Where would you find an owner's withdrawal?
oh, that is. I've got so many notes.
Don't worry about it, it's okay.
I can't find
That'd
it.
be the
I did it.
sub accounts of owner's equity.
Owner's equity. Good. Yes. It is definitely owner's equity, right? Especially when we're taking away from money from the business. What are we doing? We're devaluing our company. Exactly. We're decreasing the company's value. So in this case, what are the categories of equity?
There are no categories.
There are no
None.
categories.
Good. Now, here's the question here. If I am taking money away from my business and I'm devaluing my company, what kind of normal balance would an owner's withdrawal have?
A credit?
Ooh, what was it?
A
Debit.
debit?
A debit. That is correct because in order to increase an equity count, you would increase it with a credit. In this case, I'm decreasing my owner's equity. So I would have a debit balance. Good. Good job, guys. All right, what about advertising expense? Marketing for the business.
Expense?
That is 100% an expense. Okay? And what kind of expense would this be?
Current?
Let's take a look at the categories for expenses.
Operating.
It will be an operating expense, correct? Okay. Now, what kind of balance would an expense account have?
A debit.
Correct. It would have a debit balance. Okay. All right. What about a cost to goods sold, which is the cost of the items you sell? Pretty straightforward.
That would be the owner's equity.
Okay. This isn't devaluing or has anything to do with the value of the company. I'm essentially selling my inventory items and I'm costing it out. All right? What's that term where I need to get rid of my items? How do I get rid of my items?
You
Sell them.
You sell them. Not a revenue. It's directly correlated with the revenue.
Asset?
It's not an asset. So we said asset, we said revenue, and we said owners. What was that?
Wouldn't it be an expense because it's still the cost of? It's a cost that you need to run your business.
Absolutely. Okay. But in context, what category would a cost of goods sold be under? Let's look.
Type of revenue for sales.
Okay, so it's not revenue. We already established it's an expense. All right, let's go back up. What are the categories for expenses?
Cost of goods, operating or non-operating.
Okay, so what is cost of goods sold?
Operating?
What are the categories of expenses?
Cost of goods, operating or not.
Sold,
Oh,
yeah.
so it would be cost of goods.
Absolutely. Cost of goods sold, right? It's in its name title. Cost of goods sold has its own separate category, which is cost of goods sold. So in this case, it is COGS. Okay? Good. So remember, this is directly correlated with the selling of your inventory, right? It's the cost of selling your items out to the public. Where the other section is the cost in order to operate your business. Okay, so those are all going to be under expenses. All right.
So I'm just confused because I'm looking at the chapter 2 accounting and it says the contra sub accounts of owner's equity. Within the contra sub account of expenses, there are two subsections: cost of goods and operating expenses.
Right.
It would be okay. I got it. I got it.
Yeah, okay. Yes. Okay. All right. What about inventory? Okay, so items that you purchase that you plan on selling.
We didn't pick the normal
Oh,
balance.
yes. Sorry. Go ahead. What is the normal balance of an expense?
A debit.
It would be a debit. Yes. All right. And then what about inventory? So items that you purchase that you plan on selling.
Current assets.
It is a current asset. Yes, it is. Okay. Because we purchase it, we own it, we can turn around and sell it. Okay. And what kind of balance would it normally have?
Debit.
It would have a debit balance. Good. All right. Couple more left. So, what about land? Land is property.
Owner's equity.
Okay. Now, owner's equity.
Oh.
Does
I put
does
asset.
it is an asset? Yes.
Yeah.
It's something that you own, right? It's property. Okay, so it is an asset. Now, what kind of asset is it?
That would be fixed.
Fixed, because it falls under those three things, right? Is it property, plant, or equipment? In this case, land is a type of property. So it is 100% a fixed asset. And what kind of balance would it have?
Debit.
Debit.
It would have a debit balance. Oop, there you go, debit balance. All right, couple more. What about sales? Sales is basically earn money from selling a product or service.
Asset.
Revenue income.
Revenue income, yes. Okay, it's if you're selling your items, then yes, that would be in respective, or they're correlated with each other for the asset. But this is I'm talking about specifically the sale of the item.
Yeah.
Okay, so yes, it is going to be um, revenue or income, right? It's what you generate. So, with that being said, what kind of revenue slash income does this belong to?
Current.
Okay, let's take a look at the categories for
Oh.
revenues
It would
and
be sales or other income, right?
sales, because again, we are taking a look at the main core of a business, right? We're looking at merchandising. So, the main core would be technically operating, but in this case, our operations is sales. So in this case, it's not other because, you know, we're looking at merchandising. So sales would definitely be right. If for any reason that I say it's operating, then it's operating. Okay, operating or sales. Okay. What about the normal balance of an income account?
Credit.
It would have a credit balance, yes. All right. What about capital contributions? So investing money into the business.
Equity.
It is,
Equity.
yes, good. It is an owner's equity account. And what kind of category does it have?
Would it be a debit?
It's not a debit.
Word for. Oh, there is no category for.
Yes, there is no category for equity. Good job. All right. And in this
Would be
case,
credit.
it would be a credit because I'm investing into my company. Therefore, I'm increasing my value, right? If I add more money to my company, I'm essentially increasing the value of the company. So, yes, it is a credit. All right. Let's keep going. We're almost there. What about equipment? Equipment is going to be any machinery or object to run operations.
Asset.
It is an asset. Now, what kind of asset?
Under
It is
PPE.
PP&E, which is also known as fixed. And what kind of balance would it have?
Debit.
It would have a credit balance. Yes. All right. What about inventory? Inventory is going to be any machinery or object to run operations. It is an asset. Now, what kind of asset? It is PP&E, which is also known as fixed. And what kind of balance would it have?
Debit.
It would have a debit balance. Okay. What about a notes payable, right? IOUs to other people.
Liability.
It is a liability. Now, what kind of liability is it?
Current.
It's current. But what else can it be?
Could it be other?
Is there a,
Oh, wait a minute. Okay, yeah, never mind.
no worries. So in this case, it can be long term, right? You can go ahead and say, "Oh, I'll owe you for 9 months." Once that 9 months happens, right? I'm like, "Okay, I need an extension for another year. Give me another year," and they defer your payments for another year. So therefore, it can be short term, or in this case, current, or it can be a long term liability. Okay.
So would either answer be correct, or do you have to put them both?
Either or. Okay,
Okay.
because it has to be specified on the actual note payable, right? You have to sign an agreement to saying what the contractual agreement is, okay? But then you can always request for a deferral, okay? You can always extend your payment. So that's the difference between a regular loan and a notes payable, because you have that idea, right? But there's also when you refinance, right? And this is where it comes into property management. If you decide to refinance your loan, then you're extending your loan for even longer. Well, either way, it's still going to be a long term liability. Okay? So, again, what kind of balance would a liability have?
Credit.
It would have a credit balance. Good. And then what about a rent expense?
Expense.
Good. What kind of expense?
That would be under operating expense.
Under operating expense. And lastly, would it have a debit balance or a credit balance?
Debit.
It would have a debit balance. Yes, this is debit, man. This is a expense, right? It would normally increase on the debit side, right? Two more. What about delivery income, which isn't the main core of your business, but you charge other customers to cover for delivery?
Revenues or income?
It is a revenue slash income. It,
Current.
all right, let's take a look at what our categories for revenues and income are.
Other or non-operating.
Operating.
Either not, yeah, non-operating, or in other words, other. Okay, there's other income. All right, and what kind of balance would it normally have?
Credit.
It would have credit balance. Good. Last but not least, we have purchase expense, right? Making purchases for the business business operations for inventory. Okay, and we're going to learn the difference between the purchase expense and actual inventory when we take a look at chapter 5.
Be equity.
Okay, so making purchases for the business operations or inventory items, how does that constitute to the value of the company?
Oh, an asset.
Okay, so it's technically not an asset. Okay, if you're making a purchase for the operations of your business,
Would it be an expense?
Income.
it's an expense. Good. Okay, so expense. And then what kind of expense would this be?
Current?
Let's
Oh,
try.
no. operating?
It would definitely be an operating expense. Last but not least, what kind of normal balance would an operating expense have?
Debit.
Yes. Okay. So I see you guys struggled a lot here. That's okay. We will see this again when we dive into our study guide. So make sure that you practice, print this out as many times you want. Practice, practice, practice. Now, I'm going to give you a key couple pointers here. All right. Anything that is an expense would normally have the word expense attached to them. Okay? All right, except for cost of goods sold, of course, because it has its own category. So that one should be straightforward. You should be able to recognize that one right off the bat. But most cases, all, if not expenses, will have some kind of word in front of it and then an expense after it. So purchase expense, rent expense, advertising expense, all of those are going to be considered expenses. Okay. Another key factor here is almost all, if not liabilities, will have the word payable after it. So whether it's a notes payable, accounts payable, sales tax payable, you're going to associate that with everything that you owe. So a liability, right? Payable, meaning you need to make payments to. Payable, okay? As far as understanding assets, that's going to be kind of one of those things. It's pretty straightforward if you understand in context, do you own it? When I talk about land, do you own it? Yes, I do. If I talk about building, do you own it? Yes, I do. What about inventory? Yes, I own inventory. Do I own cash? Yes. Own supplies? Yes. So in that kind of sense, that's like probably the only key factor there. There's no methodology to it besides ask yourself the question. If you say you have supplies, do you own it? Then yes. Okay. And then other than that, equity is kind of hard to understand. The only thing, like I said, is if you just memorize what capital contributions does and what an owner's withdrawal does, then those are the only two things that you would necessarily see when it comes to equity. All right. Other than that, that's my takeaway on this. So be sure to practice this because you will be tested on this. And I'll have it exactly set up just like this, except I will ask it in obviously a multiple choice question. I will give you the account name. I'll give you the description of the account. And I will ask you determine the type, the category, and what kind of balance it has. And the answers, for example, will be A, asset current debit. Okay. All right. So, and then B would be asset other credit. Okay. So be sure you understand this part. Okay. So right now it is exactly 3:17. So go ahead and take a nice 20-minute break. So 37. Go ahead and be back by 3:38. I'll give you an extra minute. Okay.
Okay.
All right. All right. See you then.